It's my pleasure to introduce the last chat, Navigating the Independent Sponsor Model. And with that, I'll pass it over to Martin Ruhaak.
Hi, everyone. Good afternoon. I'm Martin Ruhaak. I am a partner at Katten, Muchin, Rosenman, a US-based law firm. The title of today's panel, obviously, is Navigating the Independent Sponsor Model. We're all very excited to be speaking with you. To introduce myself briefly in terms of my background, I'm a partner in our corporate and M&A practice. I spent a lot of time representing private equity participants, including family offices, committed funds, but much more noticeably and recently is an uptick in my representation with independent sponsors. So I'm pleased to be on the panel today to discuss some of my experiences with you, and obviously with the rest of the panelists here who have fascinating experiences and a lot of experience in what we're about to talk about. So with that, I'll pass it on to the panelists to introduce themselves.
Afternoon. Thanks for joining us. My name's Alex Schneider. I wear a couple different hats. One is as an independent sponsor. My firm is called Clover Capital, which I started in 2011 after a career in more established private equity firms. We have a food and beverage focus, and we're a bit life cycle agnostic today. We do control acquisitions of owner-operated businesses, much similar to a lot of ETA models. We also do venture capital in food and beverage as well, doing seed and early stage venture investing. I also teach our entrepreneurship through acquisition class at Kellogg and run the Zell Fellows program, which maybe you'll meet some of our students along the way here. So nice to be with you and look forward to the discussion.
I'm Luke Kenter. I'm with Prospect Partners here in Chicago, and I also wear a couple different hats. I'm a former, I guess I'd call myself a fundless sponsor, back 20 years ago, and did a bunch of fundless sponsor deals after a career at McKinsey, and then founded a private equity firm 20 years ago with a partner, and I've been in the private equity business ever since, investing in the lower middle market. And today I run kind of 3 portfolios of companies. I'm an active investor in other sponsor-led deals that are smaller, so I have we call them pass-the-hat deals in our shop. So I'm an investor in about a dozen of those companies here in Chicago. We have Prospect Partners, our fund business, that we're an active investor in the fund side. Today we've done about 50 different platforms, about 150 different add-on acquisitions in a variety of sectors. And then I still own one of my companies that I started back when I was a fundless sponsor. I still own it, and now we ticked off our 24th year, so I've owned that for about 24 years now. So I come at it from a lot of different angles.
Thanks, Lou. Mike Hendrie with Expedition Capital Partners, an independent or fundless sponsor, private equity owner, and started my shop in 2009, coming out of Cohen, Hennessy and Simmons. I've done 33 acquisitions across 4 core platforms, really carved out the niche to partner with operating executives, CEOs, or full management teams to either pursue deals in the sector they have historical expertise or to do a management buyout from inside. And so in a perfect world, looking at proprietary opportunities and then raising that equity and debt from the typical sources. And Lou and I are actually in a deal together. Prospect's my partner on a deal in the waste sector. And happy to be here and look forward to the discussion.
All right. Chad Strader, a partner at Red Arts Capital, founded in 2015. We're sector focused on logistics, transportation, and distribution businesses. Size-wise, 5 to 15 million of EBITDA, looking across the country. 2 companies to date, and excited to be here.
Great. Thank you guys for the introduction. So I guess the first question for all the panelists, and it would be great for the audience to get your views on this, is what in the world is an independent sponsor, and what does that mean for you? Because personally, 5 years ago, as a practicing attorney, I had no idea what a fundless sponsor was or an independent sponsor was, but obviously they come in all sorts of shapes and sizes and interests. And I think it would be great for everyone here to understand how you view that world and what you've taken out of it so far. So we go right down the line.
Sure. I mean, I can jump in. I think there's the term independent sponsor, which we've used, and then Lou used the older term, which is fundless sponsor, which I think leads to a little bit of the genesis of the model, which is you've got a deal and you don't have a fund and you want to buy it, so you are raising capital by passing the hat, or by maybe you've got your own resources, or maybe you're comfortable with the personal guarantees of taking out a personal loan. There's a number of different, I think, ways to achieve the ownership of a business through what is a kind of a catch-all. There's a wide continuum of different types of independent or fundless sponsors. I think some of them, are doing so with the goal towards raising a fund, and some of them are not necessarily interested in that. I think the term independent sponsor is sort of a catch-all for a lot of different types of entrepreneurship, through acquisition. I think the one distinction, though, between this and maybe the more traditional ETA pathways is that I think an independent sponsor isn't necessarily going into the acquisition to run a business day to day. Our firm, we're open to that, and we have and we do run some of our businesses or have taken intermediate roles with those businesses. But it's more being on the board, more strategic, as opposed to being a day-to-day operator. That's how I would sort of characterize the distinction.
I think that's probably the way we would look at it. I think it's a continuum. In our world, we've done deals where the sponsor is an ex-operating executive. He wants to come in and run the company, and he's going to come in and take over a business where he intends to run it and grow it. We would view that as an independent sponsor as well. Some people call it searchers. I think the difference between a searcher and independent may be just age. So in our case, we backed a guy who was CEO already of a company before, and he was running a second company, and he was in his 50s, for God's sake, trying to run a company. So he was an older guy, so we'd call that a sponsor. We've also been in deals with great independent sponsors that don't intend to run the company. They're going to be more like an active board member, like a Mike or an Alex, that are going to come in and take an active role in that company, be at the board level, be the investors' eyes and ears, to really do a lot of the heavy lifting. And so it can be either anyone in the middle. There's different shades of gray. So it can be someone with a more finance background, that he's an independent deal sponsor, if you will, or it could be an operating background where he or she is going to actually run that company. So for us, they're all sponsors to us. It's just a continuum across the spectrum. It just depends on what you want to do and what your goal in that transaction is.
I'd echo everything these guys said. Alex and Lou covered it well, but you hear fundless, you hear independent, and I think that the term fundless was pejorative in some level for a while. And I was at an independent sponsor conference last week in New York, and a colleague of mine who I've known for a while was swearing from the ceilings that at this conference 7 years ago, he officially changed the name of the industry. And,
to independent?
He was very proud of that.
It used to be called Bootstrap when I was doing it. It was
and
Bootstrap.
So the second anecdote that I think is kind of funny, business school professor in the private equity niche of mine that I've been very close with, I said, I'm doing independent sponsor in this industry, it's very established, and this is what, I said, since the dawn of capitalism, that was just called a guy getting a deal done and raising money. And so don't think you reinvented the wheel here.
Right.
But actually, I think the reality and relevant to this audience is, we joke about that, but the idea of what an independent sponsor is has been normalized and institutionalized. And I think that facilitates people sitting kind of in the seat that are looking to do that. The barrier to entry has become smaller. The barrier to getting a deal done and raising capital credibly is a lot lower than it has been historically because of the acceptance of this model across a lot of capital bases that historically were hesitant to give capital. Private equity in general, I think 10 years ago, very few private equity firms would have given capital to that. Traditional LPs, I don't think any would have done that 10 or 15 years ago. But now, I think there's a supply-demand imbalance of capital and good deals. And so if you can find a good deal, there is capital. And the idea that this kind of industry has institutionalized itself and gotten a better name is actually relevant in allowing people to start up and go do it.
Right. I guess the last thing I'll add is it's really dependent on the goal, long-term goal. So some folks are looking to build track records to raise funds. Some folks are looking to just might have left established private equity firm and go off on their own. And lastly, it might just be you want to start growing assets and do the Warren Buffett model. So there's a number of ways you can kind of spin independent sponsor long term, but I think, at least for us, it's building our track record, establishing ourselves in the marketplace, and continue to get some deals done.
And then ultimately be like Lou. That's my goal.
Right. Because I think what Mike said is really pertinent. I mean, when I was running around being in bootstrap, independent sponsor, whatever you call it, in 1992.
You probably didn't have a name, did you?
Probably didn't
There was
have a
no
name.
name.
It was Kenter and Company, and that's what I
But
did.
there was no
There was no name. So so I ran around. I had a deal under a letter of intent that I was trying to sell in 1992. How many years ago is that? It's quite a number of years. And I went to every private equity shop in town to try and get someone to fund my deal. And I thought it was a good deal. I liked it a lot. Couldn't get anyone to fund it. I literally could not. I went to every shop in town. I got turned down by and there were far fewer firms back then. But I went to every shop in town and no one would do it. And finally I got a guy out of San Francisco to do it, a group called Trident Capital that came in and funded our deal, and it was a very successful transaction. But back then, as Mike said, 20 years ago, this business really didn't exist because you couldn't go put yourself in between the deal and the money. The money would just say, we're going to go around you and go directly to the opportunity. And there wasn't the opportunity to, where private equity funds were buying from each other. That's also something that's really changed a lot in our world. Today, almost everything I sell, I'm selling to a larger private equity fund because that's who the buyer is. Where 25 years ago, you may have been selling to synergistic buyers who are taking a company public. The path to take a company public now is so different, and so the markets are so different today. You can walk down Madison Avenue in Chicago and raise, I don't know, $500 million in a weekend. Why would you bother go to Wall Street? It's just a waste of time. So you can raise all that money privately, and I think that's what's really helped the fundless sponsor world, is that if you were looking to raise $5, $10 million, I mean, I don't want to say it's easy, because that's not fair. But if you find a good opportunity, as we talked about before, the money will find you. It is not about the money, it's about the deal.
Sure. So just on a personal note for our independent sponsors on the panel, can you guys just give us a personal note about what made you do this? You've all been part of institutional funds before. You had that path, and what made you jump out and try something like this?
Sure. Maybe you want to start down there.
Yeah, I'll start. So family came out of an entrepreneurial family. My father owned a small business. Then also I learned about an individual named Reginald F. Lewis, who's a famous independent sponsor as well, who did about a nearly $1 billion transaction in the 80s. So after hearing his story and my father's journey, that was kind of my segue into the industry.
So I'd always had the dream of being an entrepreneur, promised myself I would, and then kind of got stuck in the world of finance, did investment banking, get into private equity. You move up, and I'd say, how am I going to go do this? And so the situation presented itself where I could go out and get a deal. And I thought, I don't know much. I know how to do private equity deals, but it's about my only skill set. If I can go out and hunt deals down and raise that capital on it, this is kind of my opportunity to go leap and take that entrepreneurial, fulfill that dream that I've always had. And so it was kind of really alignment of the stars and being able to go kind of fulfill what I'd always promised myself I would do, and then was starting to get scared I would never do.
I don't know, for me, it's always something I wanted to do, is to have my own business. It wasn't, it was an early dream, and so my process was my second year at Booth. Myself and my best friend, we spent our whole second year Booth trying to buy a company. We had no idea what we were doing. Thank God it didn't work. And there was no program that they're running nowadays. It was kind of a unique space. So, I went back and took my job at McKinsey. My buddy took his job at Drexel, and we kind of went off on our own separate ways. And I stayed in the private equity world 4 years later, but I always had the taste that I wanted to be in the ownership space of running small companies. It didn't matter to me kind of what the format was, whether it was direct or through a fund or as a sponsor. It's really kind of the same thing. You're sitting across the table from your owner-operators trying to help them create a bigger company over time, and it's the ultimate negotiation of ideas and capital that kind of drives the boat. So if you can figure out a way to grow that company, command the presence of that team to kind of grow the business, it's doing the same thing. It just doesn't matter what format you're doing it in. Sure. You know what I mean?
Yeah. So, I had a formative entrepreneurial experience when I was an undergrad, bought a business and sold it, and loved the entrepreneurial experience, did the conventional investment banking and private equity route, and I think made the realization that I didn't really like the private equity model. It's very transactional oriented, and actually that's the least that's my least favorite part of private equity, is actually the transaction. What I really enjoyed was the value creation and the intellectual sort of stimulation from seeing lots of different business models. So I was very fortunate that the last private equity firm I was at was very successful, a firm called Keystone Capital here in town. It's a great firm, and I had an amazing experience there. But the problem with most private equity firms when they're successful is they tend to move up market. And we were moving up market. We were basically, I was looking at all of these smaller deals that we were now passing on because they were just not large enough. And along came one that was in an industry that I knew in baking, and the partners passed on it, and I said, do you mind if I try and buy it on my own? And they said, go for it, and it was a little serendipitous. I mean, we closed on that deal 3 months later. I was unemployed for a day, technically, and it was sort of the right deal at the right time. But we put ourselves in a good position to do it. My business partner actually worked for Lou, and it was kind of the right deal at the right time.
Great. So maybe we can talk about some of the hot topics I think that are in the independent sponsor space and some of the challenges and opportunities that are presented by this sort of model versus many of the other institutional investment type models. And I think the first challenge, the first thing that jumps to mind is when clients call me, and I'm sure when obviously it's top of mind for all of you, is finding the deal, right? You have to go through what I would call alternative channels to do that, right? You can't go into these fully banked, high profile auctions and try to win those as a fundless sponsor. But how do you, to Chad and to Mike and to Alex, how do you find the deal? What's your strategy, and how do you think you sort of position yourself well in that way? We start with Chad.
Yeah, sure. So we're sector focused. So we spent really the last couple of years really talking to the market, from bulge bracket banks down to small brokers in rural towns, to say all we do is focus on logistics and transportation. So for us, it's really hitting the streets. There's conferences called ACG, which we attended across the country. There's a couple other organizations like SBIA that host pretty good conferences. So for us, it's just getting out there, telling folks this is what we do, this is who we are, and then once we started to close deals in the space, that continued to solidify our message of we're doing transportation logistics deals.
I am not sector specific, so kind of look at anything across the board, and I would say a couple different ways that I hunt proprietary deals. One is in partnership with operating executives that I'll typically have involved in my deal, and so that can span anywhere from on a very targeted, here's a sector, here's 2,500 targets we want to go after, mailing, calling campaigns, in partnership with that executive, and find those proprietary type deals. I have done that successfully in my first deal in the security guard roll-up. We found 3 proprietary deals to put together as our core platform to establish it like that. Kind of on the other end, I have a number of operating executives with whom we work at a more passive pace. And I'll give you an example right now. I'm, knock on wood, going to have a letter of intent by the end of this week in the aerospace sector with an aerospace executive that I've looked at stuff with over a 2-year period. The reason I will likely get that LOI, based on what I've been told, is that the fit, the seller wants to move on, he would roll out of equity in, wants to build this platform, it's his family legacy business, and that executive that we brought in fit it perfectly. His background, his history, culturally, so that kind of fit can work to help win a deal in a, call it, light auction process, because as Marty said, we're not chasing very highly auctioned deals. I'll give you a few more anecdotes because it probably tells the story better. The deal that Lou and I have is in the waste brokerage sector. It's I had chased an opportunity. It's the outsourced hauling of waste from multi-location businesses, so an asset-light model. I looked at a deal in that space, fell in love with the sector, kind of a new growing niche, highly fragmented, ripe for consolidation, but a lot of room for organic growth. I didn't get the deal I looked at, but I said, whew, this is a whole sector nobody's ever heard of that's really interesting and exciting. I did an outbound calling campaign to 80 different firms. Had a lot of good conversations. One of those guys called me back a year and a half later. He said, I wasn't the size of the platform when we talked. Now I am. Let's go do this. And so that's been a great story with Lou for the last few years. And then just sectors as well. I exited a deal in the security guard sector. The first one I mentioned earlier this year, and knew plenty of targets in that, and so I was able to kind of, on a proprietary basis, find new ones, and I have a new one under letter of intent right now. So it's a long-winded answer to say you kind of throw a lot of stuff against the wall on a proprietary basis, and there's not a narrow one answer as to how that is, but you got to be creative, because going and looking at 200 investment banking auctions every year is not going to yield very much. You've got to have an angle, and you got to have something semi-proprietary, and if it's even a light auction, you got to have a good angle as to why you're going to win it.
I think that's a good answer. I think in terms of how you find your best opportunities, I think like Mike, I think it's very hard to come up with a strategy because I don't think there's any one answer that answers that question. They're kind of all over the map. We've gotten deals from industry sector executive where they served as a river guide to a sector and they led us into a deal. We've gotten deals from financial executives that kind of knew a guy who knew a guy and introduced us to something. And I think a lot of it is, it's not necessarily knowing where the deal's going to come from. It's knowing how to say a fast no. Because what you find out, especially what I find with younger people coming into the business, they look at everything they look at looks interesting. The investment banker put the book together. Man, there's nothing wrong with this business. And then the young people come in and tell me, Lou, this is a great business. And I said, well, would you invest? I said, yeah, I think it's okay. I said, well, let me tell you why I wouldn't. And it said, it's got one customer between Home Depot and Lowe's is 70% of the business. It's mostly import, no branding. The team is 70, they want to retire and never come back again. And this company's a dead in the water. I wouldn't touch this with a 10-foot pole. And I don't say it exactly like that. But part of it is knowing what you don't want to do is almost as important as knowing what you do want to do. So, and in fact, when Mike talked about the Waste Harmonics deal, as soon as Mike was describing the deal, said, time out, we want to do that deal. Because it hit all the buttons we wanted. It was a recurring service revenue business, lots of clients. I understood why we could compete with waste versus other kind of integrated waste haulers, why we were delivering value to the clients. It totally made sense, and he had the guy. So that's for us. We need three things to do a deal, and I think the same three things always occur. It's I need an opportunity. A company is for sale, okay? Meaning there's lots of companies that you see that are roaming around that aren't really for sale. He's just kind of doing a live equity check. He wants to get told he's great and fantastic and just update where his net worth is at. And he wants to be told how great he is. He can go back to Country Club and say, I was offered 10 times and turn him down. You've got to have a hero in the story, which is who is our management team. It could be the guy who's running the business. It could be his daughter. It could be somebody else. But who is our leader going forward? Who are we backing? It's like that old story. There's no statues built to a committee, right? It's who are the one person that you're going to back and say he or she is the person we're backing. And then number three, the economics have to make sense. There's lots of good companies that you see with a good person running it, but he wants 45 times EBITDA and then he's a seller, and then that doesn't make any sense. So you have to find all three of those things to work, and so you've got to kind of churn that stuff very fast and find out stuff you want to find. And when we've gone back and look at where our best deals come from, we can find in total U of C model, regression analysis in terms of what ties to success. I think Kaplan's done a lot of this work, and what he would tell you is the number one thing that drives success is price, right? Which is like a mind-boggling thing, right? What's the most successful opportunities come from? Industry sector executive, knowledge of the space, hot sector versus a boring sector. It's price, and I hate to say it, but price does matter. So if you pay a really high price coming into the sector, your returns are not going to be as good. If you pay a lower price coming into the sector, good for you. Maybe that was market value. So you better do a great job building that thing, or you're going to sell it for the same multiple. So a lot of that is we can find no similarities of where we're finding our deals. And I'll tell you one anecdote that's weird as heck, but I love the story. We work with another guy like Mike in the fundless sponsor world named Lee Vandermine, who Mike knows, and Lee's an independent sponsor who I helped get in business about a decade ago, and he called me up on a Tuesday and said, you'll never believe it, I was at my cookout. Lee was a former lender at BMO Harris in Chicago. I was at my cookout in Naperville, and I was across the barbecue, and I knew my neighbor. I knew John. I'd never know what he did. John says, well, John, you look kind of down. What's happened? Well, they're going to close down my division. My company is selling my unit, and I'm going to be out of a job. I said, well, what do you do? I work for Culligan. I run Culligan's corporate stores. And so, Culligan had gone through a buyout, a situation prior to that, and we're trying to de-lever at a certain time. And this was again in 2010, 2011, when the economy was not as good as it is now. And he said, they're going to close down my division. I'd buy it if I had any money, but I don't know how to get a deal done. And what do you do, Lee? I help guys buy their division when they get fired. And so the following week, they're in my office. We talked about it. I immediately said, this is a great business. Why are they selling it? And the answer is because they're trying to de-lever. They've got the banks at the door and everything else. And they're doing lots of things that probably they wouldn't do if they had a long-term view on the business. They were trying to optimize cash in the short run. So I said, fine, well, maybe we'll negotiate with them. Went and cut a deal and bought the business from Culligan Corporate. We went on and built that company up. We were a franchisee of the Culligan franchisor. So we're the guy that puts the water softener, the bottled water, the filtration unit in your home or in your business using the Culligan brand. And we did 20 acquisitions over the next 5 years. And then we're coming to sell it. And Culligan itself had changed hands a few times since our ownership. Now it's owned by Advent, which is a big Boston-based PE firm. And we were coming to sell it. The management team said, no, you guys are doing a great job. And we were driving a lot of their growth and said, no, fine, we're happy with you guys continuing to grow and find another PE partner. Halfway through the process, we were already through the process, had other PE firms that wanted it. I got a frantic call back from the guys at Culligan and said, well, we had a board meeting, thought about it, we really think we want to own you. So can you come in for a meeting next week? Long story short, we ended up selling the business back to Culligan just in August, and it was a great deal for us. It was a good deal for our management team, and it was a good deal for Culligan. They had a bunch of assets that were kind of screwed up, and our team did a really good job focusing those assets, straightening them out, making a lot more money than before, so it was a good deal all the way around. But that deal, how'd it get there? It was across a cookout in Naperville. Who knows where this stuff is going to come from?
Sure.
Yeah, I'll just echo, I think, a couple things, like kind of driving points. One is opportunity cost. So, knowing when to say no, and this is true in an independent sponsor model, or if you're a search fund or anything. You can get sort of tied up in a deal that really isn't going to work, and to be able to say no and move on is really important. Lou spoke to kind of the story. I think, and this sort of speaks to what's your angle. I think markets are too efficient. They're not too efficient for you to not find anything. There's still lots of small businesses out there, but you really need a cohesive story. Like, what's the deal, the industry, and your specific role in it. Particularly if you are going to other people to raise money, like, you need a role, you need a purpose there other than being disintermediated from a process. So I think that's important. And then the last thing is, we have a sector focus. It's having an angle. It's being able to win a seller's confidence on a variable other than price. And that goes into the story side of it. So being sector focused, it allows us to focus on certain trade shows, and those are the trade periodicals that we read. We know the themes that are going on in an industry. If I have 5 minutes with an owner operator, I can establish credibility very quickly. It also helps on the fundraising side. A lot of our investors are retired C-level executives of food businesses, or individuals or families who own or have owned food businesses, and that allows us to bring in relevant people for situations. So we're working on a distribution business right now. One of our investors is the chairman emeritus of UNFI, which is the largest natural food distributor. He's retired. I think of him as a grandfather. He still has money and he has a lot of expertise. He wants to be involved, but he doesn't want to change any more diapers. I'll change the diapers. Like, that's totally cool. But he likes what we're doing in the space, and it keeps him relevant.
Sure. So you touched on, Alex, the sort of other big dominant theme in all of this, which is after you found that deal, right? You got what you wanted. What do we do about the capital? And so, Lou said earlier that finding the capital, particularly in this environment, is not difficult. And I think almost all of us would agree that there's probably more money available for this type of business and this type of model than there ever has been. And I think in my experience, and this is mostly anecdotal from my clients, is, they are sort of, it is their market now to try to find capital and what they like. And I think, from my perspective, clients, independent sponsors really like that family office capital, that sort of direct invest model. The one where it's more permanent, there's not as much pressure to turn it in a cycle, or to do a bunch of add-on acquisitions or things that they don't necessarily want to do. And I think followed by that is the mezzanine and second lien type lenders that will write really large checks or a big piece of the capital structure and be pretty deferential to the sponsor. And then of course there's the more complicated situation with the committed funds that have their own LPs to answer to and have their own fee structure. So maybe if you guys could give the audience a sense of, once you have that deal, what type of capital are you ideally shooting for? Does the deal matter, in terms of who you want to select as a capital provider, and what's important to all of you?
I'll take a crack at that. Once you have the deal, look, the dirty little secret, I think, in this environment where we're in a bull market, and this could totally change if capital markets change and liquidity is no longer there. But if I've got a good deal and I believe in it, and there's a story, if I have enough time, I'll raise the money because I can always give up economics. There's so much capital out there looking to access small deals, and if you can give up, some points of carry or some of your GP interests or something, like, you'll find capital to consummate your transaction. You may have to give up something for it, but you'll get it. You'll kind of get it done. Of course, the argument for having permanent capital is that this could all change. We haven't seen a cycle in a long time. It's a really easy environment to be raising capital on a deal-by-deal basis. And that capital can come from a lot of places, and if you've got a good deal, what's the best kind of capital? It's deep pockets that's passive, and that tends to be family office capital where you're compared to treasuries. And there's a continuum here. You can kind of go up the curve to multifamily offices that have professional managers. You can go up to funded private equity firms. It all depends on sort of what kind of governance and economics you want. We try to have a very diffused investor base. So if I've got a $10 million raise, I'm trying to raise from families and individuals at like $250 to $500 a pop. That gives me a lot of governance and economics, but it's also a lot of cat herding. It's also really painful to be trying to go through diligence and evaluate an opportunity, which is the critical half of my brain, and I'm also selling at the exact same time. And that can be frustrating, and that's sometimes the reason why people do raise permanent forms of capital.
Sure.
Yeah, I think we hit on a bunch of those pools, and each of them has their pros and their cons. You talk about herding cats with individuals. I think that's challenging. It depends on kind of your network. That takes a lot of time, and I think adds uncertainty and it lowers the probability of a deal if you don't have that really well circled. It does give you better governance and, in theory, better economics.
Good point.
You talk about the family office, kind of next up that spectrum of autonomy. I think we were at the round table we did about a year ago. We started talking about family office versus private equity among a group of independent sponsors. And I think there's been, Marty, you referenced it, that's the favorable way to go. I think there's at some level a bit of a myth that you get better economics with a family office. The flip side to which is inherently family offices, they take risk, they want to grow their capital, but they are inherently preservers of capital. Yeah. Private equity funds and mezzanine equity funds have a gun to their head to deploy that capital or they lose it. And if you have a deal, it's binary. You're a hero and you get it done, or you're zero because you failed and didn't get it done. And so you got to get that deal done. And so what is the highest probability of getting that deal done? Do you sacrifice slight economics and slight governance to ensure you get that deal done, get your closing fees, get your management fees, get your carried upside? That's sort of the trade-off you always kind of have to think about. And then, a mezzanine equity shop will give you more control. In a typical private equity firm like with Lou, where we're partnered, they have a very collaborative approach where you guys ultimately have control in that deal. I sit in the board and was talking to our CEO on the way in here today, like we'll do many days. But it's a great partnership because there's a lot of hands to do the lifting in growing a company. It's a lot of resource that needs to be allocated, particularly if you're doing a consolidation strategy or something like that. And so having that extra help that you wouldn't get in those other scenarios can be very useful in the value creation that you're trying to achieve during that whole period. So each of them has some pros and cons, but I think, one last thing, the kind of newer pool of capital is the traditional LP capital that's out there now, and they're kind of, I think it's become sexy and fun for traditional LPs who have invested into funds only to allocate a large portion to direct investing, and they want to do that often behind independent sponsors. And so that's a new avenue that I even think 2 years ago didn't really exist. But now I've seen kind of coming out of the woodwork. That would be a lot of autonomy, good economics, and also some risk because it's still unproven a little bit. But that's another avenue just to kind of throw out there among the pool of theoretical sources or available sources.
Yeah, and for us, we've both of our deals have been with the MEK Equity or the MEK Equity folks, which is a pretty common theme in the lower middle market. So there's a group of SBIC funds out there largely who will do your MES and your equity co-invest, and that helps fill the gap in, and then you kind of raise your own pool of capital from, for us, it's high net worth individuals and some family offices. But the one thing I would echo on the family offices, while it's nice to say you have a family office and it's great and it's permanent capital, it's very much a relationship building exercise. It is not transactional by any nature, whereas you'll see with probably more of the MES equity, some of the private equity funds, it's much more, to Mike's point, transactional in that they have to deploy capital, they have a mandate to do so, whereas family offices, they're not supposed to lose capital. So for us, it's really been focused on the relationships with family offices, but then as well, having great relationships with the MES co-invest guys who like to do deals and take the equity co-invest.
So Lou, for you, these guys all touch on the economics a little bit, right? So how do you view the economics as someone who's investing with these guys, and what makes it the value play for you, and how do you sort of incentivize a good deal to get done and to grow and to ultimately exit at a valuation that you want?
Well, for us, this is just it's a way to deploy more capital in other smart guys' hands and kind of we view them almost affiliates of our firm. So we have nothing in writing that says Mike has to bring his next deal to us or Lee has to bring his next deal to us. We figure if we're not behaving like good partners, then you're not going to bring us the next deal. So we want to be good partners to our fundless sponsors or independent sponsors and get them to work with us and call. Because what happens is I'm talking to these guys almost every week about a new deal. Like, what do you think about this company? Where should you think we should bid? Let's bid here. And I'm not, I haven't read any of the book, but he's asking advice on where we should bid and how we should play it. So I'm talking to these people on our, almost a daily basis about what's going on and where should we bid on companies or how should we negotiate situations. So we want to be viewed as a good partner first. We're going to be more expensive than just money because we do add our shoulder to the wheel to make these things work. And I think like Mike's situation in Waste Harmonics or Lee's situation in Culligan, there's a ton of work to get done, and frankly, there's more work than one person can do. We did 20 acquisitions with Culligan. We were doing them once a quarter and had a pipeline of 45 other deals. I mean, that's a lot of work to do. And so there was plenty of work for Lee to do or Mike to do, and as well as supported by other people at our staff, at our shop. So I think it does depend on what your deal needs. If you view this opportunity as like, I'm going to buy this thing, pay down the debt, I'm never going to do an acquisition, and I'm just going to, kind of level load the thing and just kind of go from there, and I'm going to make money by paying down the debt the old-fashioned way. Then it does come down to you don't need a lot maybe of help from a PE firm, but we're trying to create a bigger company typically over time, because I think the other dirty secret in our space is we're trying to buy companies that are smaller in nature, $2 to $3, $4 million of EBITDA, and we're trying to get them to 10 to 12 to 20. Because what happens is there's a giant growth and multiple expansion you can get if I sell a company that's making $20 million of EBITDA than one that's making $3. But today, market, a $3 million EBITDA company should sell for, I used to say 5, maybe it's 6. It's probably not 8. But if you get a $10 million company today or a $12 million company, it is 8. Mm-hmm. And it's maybe 10, and it's maybe 12. So if you can take that company up in kind of a fighting weight, if you will, to the next level, you'll make a lot more money. So part of our strategy was Waste Harmonics as well as Culligan. We're trying to build a bigger enterprise. And if you looked at the universe of stuff people are trying to buy in the private market, there's just not that many companies that are really well professionally managed that are north of 10 to 12 million of EBITDA, and that creates the scarcity value. There's lots of companies at the $2 million EBITDA that are well managed, but they may be $2 million of EBITDA for a reason. So they can't grow, or their market's limited, or some other issue. But there aren't that many companies that have a track record where you can see they used to be here and now they're here with that same team running it. That's an attractive asset in today's market. So that's what we're trying to build. And for for the sponsor, you have to figure out what asset do I really have here? Do I have something that can really run, or is this a nice little small asset that is going to be great, but it's never going to be a bigger company? And that's what, frankly, led us to work with our fundless sponsors and stuff, that this may not be a bigger company, but I want to work with Mike or Lee or whoever it's going to be over time. So I'm going to invest in that company. He's going to run it, and I'm going to view it like I'm just an independent investor in his deal, and I've got a dozen of those kind of things with different folks. But we want to be close to those people and prove that we're good partners. The one thing I would say about money, and again, it's partner to this universe. First of all, I think that you're right. The flavor du jour is I'd like to have a family office. I will tell you, my experience of family office, if you talk to investment bankers that are selling companies, they think those guys are, a cat with no cattle, or a hat with no cattle. They are the biggest wasters of everyone's time because they don't close anything. I'll give you a perfect example. We were selling one of our companies. We were selling it to a family office. The family office is big enough that it has a team of former private equity guys that work for the family office. And these guys are wealthy enough where they own a baseball team. And we were selling a company that was going to trade in the $90 million range or so, and we thought we had a deal with them. It was sold by a investment bank. I'm trying to remember who sold that, big investment bank here in town. And we thought we were down the ways, and we thought it was going to close, and the team is all excited. We have our documents moving around, and then, at the end of the day, the two brothers came in who, wanted to look at the deal, and it's clearly they kind of knew generally there was something going on, but they weren't totally up to speed. And I sat through an hour-and-a-half meeting, and they kind of hemmed and hawed, and at the end of the meeting, they kind of said, "Nah, I don't think this is something we're going to do." And I could see the guys who work for these people were just saying, "What the heck? We'd update you. We told you we were doing this," and they got off on a red herring of some one issue that they thought they couldn't live with, and because one of them had seen a deal like that 30 years ago, and they didn't want to do it, and they just walked away. And we kind of said, "I will never work with these guys again because they're not predictable." One of the issues you want from a buyer, if you're an investment bank trying to sell a company to a buyer, is he's predictable. You know what he's going to do. If I show you A, he's going to pay B. And if you don't know where these people are going to come out, that's risk to all of us. Sure. The second thing I'd say in terms of having money for those of you who get a partner to join you, and we talked about risk allocation. Do you have a family office or a PE fund or use more debt? We have lived in an era the last 10 years where the banks have been your friend, and the banks have been happy to lend you money. I will tell you, in 2009 and 2008, when I was in the private equity business with a fund, I had companies, that same company that we sold for $90 million, that same deal in 2009, I was in front of a bank who remains nameless, saying, "You guys have to write a $3 million check or we're going to foreclose." And we said, "Well, we're not going to write a $3 million check because I don't think you'll foreclose. But we will put some money in to show our commitment. We're committed to this team and this company." So we wrote a check on infinite multiple of EBITDA. And because we back these guys, they're still friends of mine to this day. And we said, "Look, we believe you guys will come around." It had to do with in the building services space. It was totally flat on its back. The question is, when's it coming back? You don't know. So you're writing a check into the abyss. Mm-hmm. That is value. And if you are an independent sponsor, and God forbid one day you have a screw up in one of your businesses, and the bank says, "Hey, you got to be here tomorrow morning to meet with my workout guy," and you don't have the ability to write a check or to call 40 of your closest friends to write a $10,000 check, that is a problem, because you're only as good as your word. And to a commercial lender who feels like his back is against the wall, you're only as good as the check you're going to write. And right now we are not in that world. We are in a world where the banks are desperately trying to compete against the non-banks, the Monroes, the Madisons, and everyone else that are doing these off-balance sheet deals. But at some point, this thing is going to turn, and the economy is going to go through its maybe decade-old hiccup. But there will be a time where you're going to need to write a check. Hopefully, it never happens to you. But if you're in this business long enough, and you're in long enough for another cycle, it's going to happen. So you have to plan to have availability or money in your pocket that you can put into that company to support it. That's one of the things. If you are an independent sponsor, that's what you're supposed to do. You're the money, you are the guy putting the money into this deal. So you've got to be prepared to support it. Sure.
So now that we're sort of up on the clock here, I just want to maybe put some parting thoughts out there. And I guess the big question, and I think it's a good question for everyone to hear in the audience is what's next for the independent sponsor model, right? It seems to be at an inflection point. There are, serious established independent sponsors at this point, like the folks on this panel who have been doing it for a long time, have track records, and are starting to think about, do I raise a fund now? When do my exits really start to roll in and pile up? And how do I utilize that capital going forward? And what is my future like? So, give me a sense of what you guys think if we're on this panel in 3, 4, 5 years, what we'd be talking about then and what it would look like for you. Alex, we're going to start.
Sure, I don't know that I can answer that question. I mean, that's what I love about our model. It's flexible. I think we toy with raising a fund sometimes for all the reasons that Lou kind of talks about. There are certain circumstances where being an independent sponsor doesn't work. If we're trying to buy from a corporate seller, you've got a corporate development person who doesn't care who we are. He just wants to make sure he gets the deal done, and having a funded private equity firm, sort of trumps, everything that I can talk about, like my track record and whatnot. I value flexibility a lot with my family, with our ability to invest a lot of different ways. If we were a traditional fund, I don't know that we could do the venture stuff that we do that we've enjoyed and we've done pretty well with. It's hard to do kind of multiple, I think, strategies raising outside capital. I think it'd be hard to be teaching and to invest in other things when you're tied to a fund. I think Lou's been able to do that, I think, pretty well. But there's a lot of restrictions with the fiduciary duty of taking people's capital and committing to deploy that within a certain amount of time. I think in 3 years, I wouldn't be surprised if we're still kind of entrepreneurial about it. One of the things I didn't like about working for a fund was that I was on 6 boards at the same time and, not really adding a lot of value with any of them. We have 2 platform investments today. One might sell next year, and another, hopefully we're under letter of intent with another one here in the next week or so. And having 2 to 3 control businesses at any given time is sort of the right fit for me. So it's a question that my partner David and I talk about all the time, and I don't know.
Sure.
Where the sponsor business is going to be?
I know where that's going to be, yeah.
I think it's going to continue to flourish. I mean, I think what's going on is the flow of money is changing the way the world is operating today. Me personally, I think we have plenty of private equity firms. I don't think there's an overhang. If you haven't studied this business, there's an overhang of something like $1 trillion in the private equity space. So there is no extra money that needs to be deployed out there. There's not a bunch of LPs waiting to find the next fund to invest in. They're getting bombarded by people like me trying to raise money. So I'm not sure that you're going to see the private equity business expand per se. I do think the existing funds that are out there have plenty of capacity to deploy the opportunities they're seeing. It's the heart of capitalism. We need people like you to go out and start businesses and find companies to grow them. And one of the things I tell the companies I'm in, deploying capital and creating jobs in our economy is a higher calling. So trying to find those opportunities where you can put people to work, give them a place to go work, give them a place to have a satisfied career, that's a high calling, I think. We get kind of pummeled in the press about being, kind of bad people. At the end of the day, I'm very happy with the kind of careers and jobs and companies we've created. And I think if you think that's what you want to do and you can't find satisfaction with another employable job, you become a private equity sponsor and try and find an opportunity. And it's the ultimate capitalism, man. If you can find a good company, and it doesn't take hundreds, if you can find 1 or 2 good companies in a career, that may be all it is. But if they happen to be named Amazon or PayPal, that's a good deal. So I think you got to find something that floats your own personal boat. What makes you happy? What fulfills your aspirations beyond money, and beyond what do you think you're trying to contribute to the group here on planet Earth? What do you think you want to do? And I think if you can find what drives you and find a company that you're really excited about, that's about as good as it gets. So I think it's going to be here. It's going to be around a long time. Find a good company, find a good partner, and go forward and prosper.
So what do I want to be when I grow up? It's a good question. I think Alex hit, and we've never talked about this, but our thoughts are almost identical, and I think there's a lot of merits to the fund model. I think The stability that you have in that model is appealing. The fact you don't have to go out and raise capital on every deal, get your foot in the door on more opportunities and have a broader team around you is interesting. But I don't think it's the end all be all that it once was, probably 10 or 20 years ago, as the only way to go forward. I think there's going to be an evolution of normalization of kind of more creative capital going out and getting deals done, and I think we're seeing that. You know, I think if you're in this room inherently by self-selection, you're having entrepreneurial ambitions, and this is, as you said, the ultimate entrepreneurship. I mean, you started this by putting a presentation together and saying, I'm a fundless sponsor. There's no barrier to entry. Some barrier to success, but none.
PowerPoint, that'd be about it.
Exactly.
Website,
yeah. Website and PowerPoint, boom, you're in business. LLC.
Fake it till you make it.
Uh-huh.
Smoke mirrors and somebody else's money.
But yeah, at one hand, that's scary, terrifying, but it's exhilarating too. I mean, going to bed at night and thinking about it and waking up being the first thing you think about is actually kind of fun. And then the other element to that you think if you get into a fund, not that there can't be a great upside, there's some infinite flexibility, personally, professionally. I've almost closed a $400 million deal. I've almost closed a $150 million deal. Deals of that scale can come along, and if they're pseudo-proprietary and you have an angle, you can close them. The scale of earnings you can make off something like that, or multiple ones like that in your career without splitting that across a fund with similar type of carried economics is exciting and kind of keeps you awake. And so I think the entrepreneurial spirit it really plays well into that ultimate flexibility you have in this model. And so when you think about, is the fun the end game for most? I would say of our colleagues, it's maybe for half.
Right.
And I think others really enjoy this model.
I'd say it's below. You think it's that high? It's half people? A lot of people I know
maybe
like what they're doing, and frankly don't want to fund. I think the thing that's trapping money now is we're almost captive to our own audience, right? We've created good returns over the last decade, and so they're pushing you for higher and higher IRRs. And here's a perfect example. You know, if I gave you a chance to invest in one company that we were going to own for 20 years and it was going to own 22% IRR, but you own it for 22 years, or you had another company you own for 3 years and you had 40% IRR, which one do you want to own? My limited partners would say they want the 3-year deal at 40% IRR because that's how they get paid. They get paid on IRR. Now, if you personally had your money in there and you could reinvest for 22 years at 22%, you run that math at home on your little calculator and figure out how big that company is. That's a far better investment. But that's the fund world versus the individual world. And so I don't think it's as straightforward as, you know, it's apples or oranges. I do think it's deal specific. It's kind of what you want to do if you're building a Warren Buffett type approach and you want to have a view of, I'm going to hold stuff for over a really long period of time. That's just a different point of view, and they're not necessarily mutually exclusive. Sometimes you can do a little bit of both, but you got to find whatever you think you want to do.
You know, I would just add, and hate to sound like a broken record, but it's the flexibility. It's we don't have investment horizons. We don't have any industry that we cannot look at. So if a deal came today from the food and beverage industry, we could take a look at it. And
yeah, or you could send it to me.
Yeah. Yes, we could. Yeah. So for us, it's the flexibility, and then as well as the idea of long term. We don't know what we want to be yet. So we don't know if we want to go the fund route. We don't know if we want to hold assets for a long period of time. So for us, it continues to give us that flexibility. And I think until you've probably been on this side of it, it's kind of hard to understand what that enjoyment and exhilaration is each day, but it really is something unique to say, well, today I want to go look at X deal, or I want to go learn about this industry. So for us, it's at least sounds like flexibility is probably a big piece of things here.
Sure. Great. Well, thanks everyone for your time. I know we've got to get you to your next panel, but appreciate it. And a round of applause, please, for our panelists. They did a great job.